I think really what we're seeing is a bit of seasonality in the market at the moment. February, you tend to see quite a low number of sales, so you do get some natural volatility. I wouldn't necessarily take this month's figures as a guide to what's happening. You are, through the period of growth, going to see months where values fall, months where values rise, and obviously there's seasonal effects at play. What will be more interesting is the trend over the next 3 or 4 months. If that continues, it definitely highlights weakness. In a market like Perth, for example, we've been seeing a slowdown in the rate of capital growth and some more regular falls over the last 4 or 5 months. So to me, it suggests a market like Perth is definitely cooling, but I don't know that I could necessarily say the same yet for markets like Melbourne, Sydney, Melbourne, Brisbane rather, and Adelaide. Not really, no. I think the thing that always drives people to the Brisbane market and to a lesser degree Adelaide is the fact that it's a lot more affordable to own or to purchase an investment property there than it is in Sydney and Melbourne. And if you think what's happened in Sydney and Melbourne over the last 18, 24 months, you've had very strong capital growth and you've had an erosion of rental yields. So any astute investor looking at Sydney or Melbourne at the moment is probably going to think to themselves, my best opportunity to buy into this market and achieve strong levels of capital growth is past. I should have bought 18 or 24 months ago. And the gaps really widen between the prices in those two cities and the prices in Brisbane and Adelaide. And they're the things that always attract people to those cities, plus the fact that rental returns are a lot stronger. So from an investor's perspective, both of those markets are looking more attractive, but also potentially people being priced out of the Sydney and Melbourne market may look to Sydney and Adelaide as a viable alternative where they can get more affordable housing than what they'd be getting in one of those two markets. Again, I think what we're seeing in Hobart is a little bit of volatility, remembering that it's a very small market. Typically across Hobart you'll see 200 to 300 sales a month on average, and obviously in February you're seeing a lot fewer than that. So I think we are seeing a little bit of volatility in that market. If you look at Tasmania, you've still got a very high unemployment rate, low economic growth, so there's not a lot of drivers of that market. With low interest rates and the fact that the market's gone nowhere for such a long period of time, maybe we will see some low levels of capital growth over the next 12 months, but I certainly don't think that 7.9% growth over the last 3 months is necessarily reflective of the sort of growth we're going to see in Hobart moving forward. Well, I think we'll probably start to see some affordability constraints pretty soon. If you look at the median price for a house, it's $700,000. For a unit, it's about $520,000. So for people that are looking to get into the market, very few options. They either need to buy an older unit somewhere in the inner city or move to the outskirts of the city and be able to afford to buy a property. Obviously low interest rates are a key driver of the market at the moment, but I don't necessarily think what we're seeing at the moment is sustainable. Our view is we'll still see capital growth in Sydney, and that's because it's been a long-term underperforming market for the last decade. Not a lot of new supply, although that is starting to change. But we think in 2014 growth's probably somewhere more in the line of 5 to 7, 8% rather than the 15% odd capital growth we've seen throughout 2013.